Housing crash 2024 will be worse than in 2008. Will the housing market collapse in 2024, and why will the housing market crisis be worse than in 2008? Although average mortgage interest rates continue to be significantly higher than last year and this year, and real estate prices remain at an unattainably high level, demand for housing still remains at the same level. Second home sales are at their lowest level since the height of the foreclosure crisis in 2010, and mortgage demand has dropped to record lows not seen in more than 2 decades. At the same time, we continue to live in a period of economic uncertainty. Household debt, including mortgages, credit cards, and student loans, recently exceeded $17 trillion. In addition, inflation remains above the Federal Reserve's 2% target rate, and a recession is still possible in 2024. The question arises: could the housing market face a crash? The Federal Reserve Bank of Dallas has identified signs of increasing instability in the U.S. real estate market in a report for 2022. Although the sharp rise in house prices does not indicate instability, the report notes that there are other major factors that should be considered. Among them are changes in disposable income, the cost of loans and access to them, supply problems, as well as rising labor costs and construction materials, which are the economic reasons for the steady increase in real housing prices. When it is widely believed that the current steady price growth will continue, the housing market becomes less resilient to these major factors, the Dallas Fed report notes. If many buyers share this view, purchases motivated by the fear of missing an opportunity can lead to higher prices and reinforce expectations of a significant increase in house prices. A bubble has 3 characteristics: price increases driven by speculation, bubbles fueled by credit expansion, and bubbles that burst, says Kiefer. Although house prices rose at a record pace in 2021, the reasons for the increase were primarily not speculation or credit expansion, but historically low mortgage rates and major changes in housing demand. But what about people who purchased housing during or before the pandemic and are now seeing a decrease in the cost of their housing? Keith Gambinger, vice president of mortgage website HSH.com, he says that if you bought a house for $300,000 3 years ago, last year you could have sold it for $500,000, but now you can only count on $400,000. However, he is not ready to characterize this as a burst bubble or a crash. Banks issued mortgages with low requirements for rates and interest payments, as well as with low requirements for borrowers' credit history and income. As a result, many banks check borrowers' credit history and income more closely and also require higher solvency rates. More thorough checks and stricter requirements allow banks to issue mortgages only to those borrowers who have real opportunities to repay the loan. This reduces the risk of default and helps prevent a repeat of the 2008 housing crash. In addition, after 2008, a number of new rules and regulations were adopted aimed at preventing a repeat of the crisis. For example, restrictions were imposed on the size of loans and requirements for the reserve capital of banks. These measures also strengthen the financial stability of the housing market and reduce the risk of crisis. Thus, today's housing market differs from the housing crash of 2008, with stricter lending standards, more thorough screening of borrowers, and the introduction of new rules and regulations to prevent crises. This is indeed a significant difference between today's housing market and the housing crisis of 2008. A large percentage of homeowners with equity in their homes means they have more financial options and flexibility in the event of an economic downturn. If housing prices decline, they can sell their property or use their equity as a safety cushion. While in 2008, many homeowners were underwater, meaning their homes were priced below their mortgage debt. This meant that they could not sell their property without losses or gain access to their own capital for financial support. This difference is an important factor that can help mitigate the effects of the economic downturn in the housing market and prevent a repeat of the 2008 housing crisis. It is also worth noting that the demand for housing has remained high in recent years, especially in some cities and districts. The growing population, the decrease in unemployment and the increase in income also contribute to the constant demand for housing. Banks and other financial institutions are also taking measures to prevent a possible collapse of the housing market. They strictly control the issuance of mortgage loans to avoid overheating the market and creating an unstable situation. Thus, although some housing price increases may slow down or even stabilize, the likelihood of a sharp drop in housing prices in the near future remains low. Experts believe that a market correction is more likely, which may reduce some of the current overheating, but will not cause a collapse in prices. For home buyers, especially for beginners, the following recommendations may be useful. 1. Create a budget and determine your financial capabilities. Consider not only the cost of housing, but also other expenses such as utilities, taxes, and insurance. 2. Explore various financing options, including a mortgage. Compare the rates and conditions of different credit institutions to find the best deal. 3. Do not rush to make a decision. Explore the real estate market, look for information about prices and availability of housing in different areas. Make an inspection of several objects to see different options. 4. Contact the professionals. Consulting with a real estate agent or financial advisor can help you make an informed decision and avoid possible problems. 5. Consider buying a home outside the city or in less popular areas. Housing prices may be more affordable, and the quality of life may be just as high. 6. Participate in the first-time buyer program, if there is one in your country. This can provide additional benefits and subsidies for home purchases. 7. Don't forget about the long-term perspective. Although today's housing prices may be high, the market may change over time. Long-term ownership of real estate can be a profitable investment. 8. Be prepared for the fact that the process of buying a home may take time and require patience. Do not despair if you do not find a suitable option right away. Keep an eye on new offers and stay in touch with real estate agents. 9. Do not forget about the importance of checking the condition of a home before buying it. Contact a specialist to make sure that the object has no hidden defects or problems. 10. Do not forget about your needs and preferences. Buying a home is a big decision, so it's important to choose something that meets your requirements and creates a comfortable environment for you and your family. What do you think? Will there be a housing crash in 2024? Do not forget to write your opinion in the comments, and also think carefully if you are going to buy residential real estate this year. Thank you all for your attention. Recommend this video to your friends. A new video is coming every 2 days. Soon. Be sure to subscribe to the channel, and you will improve your financial thinking and finally start investing. And like it.